lesson 4 and getting near to the end of our program here. This is Professor Jeff, and we're going to talk about budget planning, which is our financial plan. This is something where we're going to focus a lot on principles and calculations to get you ready for the final exam. So, an overview for this evening, we'll be talking about cheating, which we don't want to have happen, budget planning principles, and examples, including the homework that was due. The plan for the final and the pursuit of success are going to be covered in the next video, so we're going to focus on the first 3 for this video. And we're going to work back and forth between items number 2 and number 3 as we go. Now let's talk about cheating. First of all, resist the temptation. It's not worth it. Working so hard to get to this point, and then a slip up of borrowing or stealing someone else's answer is something that results in a 0. Now, I'm going to help you on the final. Not only am I going to allow you to have 2 pages of notes to bring with you, but we're also going to have all the takeaways that I've been providing for the lectures, which is a condensed way of understanding what are all the key principles among all the details of information. So let's talk about financial plans, some of the terms that we're going to work through. So we talk about profit, which is basically the revenue. That's all the money that is taken in by a company, less expenses. And when we talk about profit margin, we're just putting that into a percentage. So it's just revenue less expenses divided by the revenue. And if we know revenue and profit margin, but we need expenses, we can just reverse the calculation around, and we have a formula for that. And conversely, if we know expenses and profit margin, we can also calculate the revenue. Know these formulas for the exam, and don't try to have to cross calculate them. Just have them ready for you when you do your calculations on the exam. So let's talk about how professional services are charged. Now, they are reimbursable expenses. They're either a pass-through plus a percentage, or they might be a fixed cost. That's one way that services can be charged. Oftentimes, they are charged based upon multipliers of hourly rates. And this is where we get into terms like the break-even multiplier, which just basically means what is it with no profit in it? And there's a formula for that. It's just the total expenses divided by the direct labor that an organization has. And you divide the 2 and you come up with break-even multiplier. Remember that total expenses is everything that a company experiences. Direct labor, indirect labor, labor burden, and G&A. And we'll talk more about what that is later in this lecture. Also for target multiplier, that's the desired rate that we want to apply to each of the hourly rates that has profit built into it. And so if we're trying to work back and forth between break-even multiplier and target multiplier, the formula is right there. Break-even divided by 1 minus the profit margin. Another way of calculating that is the total expenses plus profit, which is basically the revenue, divided by direct labor. Services are charged as a multiple of direct labor costs, and this covers everything we need to know. Everything in this green box is super critical for your understanding. So let's get into some of the homework. Questions number 2 and 3. How are professional services charged? Now, if we get into your hourly rate, if you expect to be paid $65,000 a year, that's about $32 an hour. So what would you expect your company to charge you out to its clients? Many people think, well, it's just 10% more because that's profit. Not so. They're going to be charging you out for $100 to $125 an hour with the intent of having a multiplier of 3 times to 3.5 times. That might sound outlandish, but it really is important because there's rent, utilities, insurance, medical, vacation. There's an accounting department that has to be paid for. There's a lot of things that have to be included in your billing rate to cover the company expenses. And so that's why the multipliers are so high. Let's do some financial plan calculations. So if you are planning, projecting a profit of 19% next year based upon expenses of $10 million, what should your revenues be? Well, the formula is quite simple. Revenue equals expenses divided by 1 minus the profit margin is $12.3 million. And that makes sense. We want our revenue to be more than the expenses in order to achieve profitability. Another way of looking at it in a negative way is, what if you're projecting a loss of 5%? We go through the same calculation and we come up with $9.5 million. But wait, it's less than the 10 million. Well, that makes sense because you're losing 5%. So if you're projecting a profit of 5% and your revenue is $10 million, what would be your expenses? We plug it into our other formula that we already set aside. It should be $9.5 million. Makes sense. $500,000 would be the profit that comes in on top of that. And now if you're projecting a profit of 5% on total revenue of $10 million, what would your profit be? I already gave the answer away, 500,000. Sorry, I worked ahead of myself on that one. So let's talk about reviewing budgeting plan terms. Revenue, which is all the income that comes into the company. Expenses, everything that gets paid for. Profit are those monies that are left over. And if you're at a loss, you're not going to last very long. Billable hours is really important here. The more you have billable hours, the more it ensures profitability. Non-billable hours are things that companies tend to avoid because you can't get compensated from clients. Utilization rate is how much of your hours can be billed to another client. Labor multiplier, we talked about target, which has profit in it, and break even. Expense categories. So this is an area that we said we were going to come back to. There's direct labor. That's the time charged on a billable project. Indirect labor is time that can't be charged. It might be your vacation time. It could be time you spend training. Non-labor direct. These are project expenses that can be reimbursed. So if you have to fly to Wichita, Kansas to see a project site, that plane flight should be reimbursable by your client, and it's not labor related, it's an expense. Payroll labor burden. This is the labor expenses on top of the labor wage. So if you have an accounting department, those people need to get paid, and they are part of the payroll burden. There's general and administrative, which this is what it takes to operate the business: rent, utilities, insurance, and so on. Let's go back now and do some example calculations on some of these things. If you're projecting a 19% profit next year based upon the following budgeted costs, we've got direct labor, indirect labor, labor burden. It's a whole lot of stuff. What will your break-even expenses be? Well, it should be all the expenses divided by direct labor, and our break-even multiplier is 2.375. What would our target multiplier be for a goal of 19%? Well, we take our revenues, which would be as we've calculated from all those income categories, the $9.5 million. That's adding in all of the costs. Those are our expenses, and we divide by 1 minus the profit margin, and that results in a total revenue of $11.7 million. What's the target multiplier? Well, in this case, it's just break-even multiplier dividing by 1 less the profit margin, and we come up with 2.932. This makes sense. It's higher than the break-even multiplier. Why? Because it has profit built into it. Now, if we want to achieve a multiplier of 3.1, all of our costs, with all of our costs remaining the same, what's going to be our profit margin? Well, we do the 3.1 times the direct labor budget of $4 million. Gross revenues are $12.4 million, much higher than what we had calculated above, and that makes sense why the profit margin now is 23.4% compared to the 19%. Remember this form of calculation for the final. It's going to be very important. We now get into homework number 4 for budgeting plan calculations. If you're projecting a profit of 16% next year based on labor costs of 2.9 and revenue of 9.3, What will our total cost be? Well, we use our formula that we came up with earlier in this presentation, and it calculates as the $9.4 million times 1 minus the reduction of the profit margin. So our total cost is $7.9 million. What are our break-even costs? Well, that's going to be our total cost divided by direct labor. We calculated our total costs in the portion up above. We're dividing it by the direct labor that was part of the givens. We have a break-even multiplier of 2.672. We now ask ourselves, what will our target multiplier be? Well, there's two ways to calculate it. One is we take our break-even multiplier that we calculated above, we divide that by 1 less our profit margin, 3.181. There's another way to calculate that. It's our total expenses plus profit, which is basically the revenue, and we divide by direct labor. That's the $9.3 million. That's the revenue that was given up above. We divide it by the direct labor given, and we have 3.181 as our target multiplier. And this wraps up our sample calculations for tonight.